first CoStar Industry Update event. My name is Jeanette Weiland, and I'm the Vice President of Bio, Innovation, and Special Projects for the New Orleans Business Alliance. I want to thank you for being in attendance this morning, as well as thank our partner, the Urban Land Institute, for helping us produce this event. Now, if you were with us last year in November, CoStar was one of our presenters for our quarterly real estate breakfast series. New Orleans Business Alliance, along with the Urban Land Institute, have teamed up with them to equip you with even more great content to help keep you informed about what's going on in the real estate industry. This year, CoStar Group will have its own quarterly industry update events, and we will continue to produce our quarterly real estate breakfast series. Please know that CoStar Group is the largest commercial real estate information and analytics provider in the country, and the comprehensive data that they provide can help guide you in your real estate decisions. We will have a question and answer period at the end of their presentation, and we encourage you to please enter questions into the chat throughout the presentation. So to get started, today we have with us Justin Boyer, Director of Market Analytics, Itziar Aguirre, Senior Market Analyst, and Chelsea McCready, Director of Hospitality Market Analytics. They will discuss the real estate trends happening in 2021 that will help you get past the COVID-19 global pandemic. So welcome, Chelsea, Itziar, and Justin.
Thank you.
Justin, I'm going to leave it to you to go ahead and drive your presentation when you're ready.
All right, sounds good. Thanks, Jeanette. And thanks ULI and the New Orleans Business Alliance for having us today. We're happy to be here, and certainly New Orleans is a city that's near and dear to my heart, and we're glad to cover it. So let's jump right in. I'm going to start with an economic update, and I'll explain this picture. So this is our CEO on the right, Andy Florence. This is from an all-hands meeting yesterday, where he showed a picture of his family. And of course, the first thing I noticed was the Tulane shirt, but it was also, he got kind of choked up, which is something we don't see often. He said it was the first time that he was able to see his father, who's pictured there in the middle, in a year. And they're all fully vaccinated. So he's pretty optimistic, and they're developing a plan for us all to come back to the office. So this kind of gives you a sense of where we're at and where we're going, a lot of optimism. So let's start with the big elephant in the room, COVID. We'll talk about that. So as you can see, nationally, new cases are way down from peak. That's being aided by, of course, the vaccination efforts and continued social distancing and mask wearing and such in places. But particularly the vaccination efforts have really helped with this. Cases nationally have kind of leveled off. There's been a slight resurgence. Of course, there are the variants, but overall, this seems to be trending in the right direction, and cases are the lowest they've been in several months. If we look nationally at how many are vaccinated, so it's about 1 in 5 Americans are fully vaccinated, and 1 in 3 have had their first shot. And you can see it in Louisiana, it's a bit of a darker shade. So as far as southern states, Louisiana is outperforming most of the others in terms of getting needles in arms. So that's certainly a positive trend for Louisiana. This is from the CDC. So this is looking at when we anticipate that about 70 to 90% of the US population will at least have their first vaccine shot, which could be as early as June to July, middle of this summer. And the 70 to 90% vaccinated number is the number that the CDC has always given as a measure of herd immunity. So this is when the economy could really start to open up full throttle, where we could go from 25 to 50% occupancy or capacity at some events to 100, and start to see more entertainment, more sporting events, more large events and things of that nature, which certainly for New Orleans with conventions and tourism, would have an enormous impact. So I'd be looking out for middle of the summer. Things could really start to turn around in a major way. So if we look at how Louisiana is performing relative to the US, so in the top left, you can see this is for the state of Louisiana, new cases. Louisiana, the case rates is actually about as low as it's been since the start of the pandemic. If you recall, after Mardi Gras last year, there was a sort of an early, New Orleans and Louisiana emerged as an early hotspot because of strict lockdown measures, social distancing measures, et cetera, in the state. Louisiana's really managed to get cases under control, and outperform most states in the nation. If you look at hospitalizations, these are also about as low as they've been since the start of the pandemic. And if you look at deaths, this is about as low as it's been since the start of the pandemic. And important to note here is that the vast majority of those 65 and older in the country have already been vaccinated because they were prioritized. And this is, of course, the highest risk group. So these are really positive trends in terms of reopening our economy. So we switch gears a little bit. Let's talk about the unemployment rate as a gauge of how the nation's doing. So you can see here that in this blue line that we had this really long-term trend, in the last cycle after the financial crisis, in the unemployment rate declining, and that shot up quite significantly during the pandemic, and up to nearly 16% or about 15%, and now that's numbers come in around 6%. Part of this is due to, unfortunately, a reduction in the labor force. Is a lot of folks that went out of the labor force have yet to re-enter. That could be due to, the extension of unemployment benefits. That could be due to folks being sort of discouraged about the job market. Maybe folks who were in the service industry who didn't feel protected, or, more hesitant to go back in, which is something that New Orleans should also monitor. But certainly being on the front line there, and then just overall, some folks are having difficulty getting jobs where there are really high demand sectors, and then not all sectors have started rehiring in full just yet, since we're not quite out of the weeds. So as people get vaccinated, as the economy reopens, we see this trending the right direction. We've still got a long ways to go. There's still about 10 million more unemployed than were employed pre-pandemic. But as you can see, this we forecasted sort of more permanent knock-on effects from this, and you can see that there's been a really, really sharp turnaround here.
Yeah, and we can see in this chart that New Orleans has by far seen the sharpest rise in the number of unemployed people. And besides Lake Charles, Katrina now unfortunately pales in comparison to the number of job losses seen in these metros. So New Orleans lost more than 106,000 jobs in April and March. And as we know, NOLA has an outsized tourism exposure, accounting for about 1 in 3 jobs. And all sectors have been affected, but the biggest story by far is leisure and hospitality, which is still down by more than 30,000 jobs, and really any industry affected by social distancing and a slowdown in travel. But it is nice to see that the unemployment numbers across all metros are trending in the right direction. So we can see in this graph that most of the sectors, besides state government, mining and logging, and local government, are all bouncing back. So they're all headed in the right direction nationally. But then if we look at New Orleans still has a ways to go in terms of recovery, and that explains the high unemployment numbers we just talked about. Given how heavily tourism-focused economy New Orleans is, the fact that accommodations continues to lag is not very promising. And tourism, just as a side note, tourism has an economic impact of over $9 billion in a good year, which represents about 12% of New Orleans' GDP. And arts and entertainment has barely just started to come back, so that has a ways to go. But it's nice to see retail trade and healthcare, they're coming back nicely. And COVID put, for example, some elective surgeries on hold, but it looks like they're slowly bouncing back. And healthcare is a huge employer in New Orleans.
Thanks, Itziar. And it's also nice to see professional, scientific, and technical just now looking at it, the the white collar employment that was more adaptable to working from home is actually more than recovered the job losses. So that's certainly nice to see as well. So we look at all the major markets in terms of job loss. So every major market lost jobs over the past year in the pandemic. No surprise there. It's the worst recession we've seen in a very, very long time. A lot of the cities that lost the least amount of jobs were the Sun Belt metros that are growing really fast in terms of population. Some household names you see here. On the right side, unfortunately, New Orleans, given its heavy tourism exposure, heavy oil and gas exposure, and heavily international trade exposure, actually ranked at the sort of the bottom of the list in terms of job losses. There are only 4 places in the country that saw more job losses on a percentage basis. Would be Long Island, New York, Las Vegas, of course, with arts and entertainment, Rochester. So some of the legacy Eastern Seaboard markets, which have some more long-term, issues where folks are moving out of those markets, but also, the Las Vegases of the world, it's really tourism focused. So we look at taking the pulse on the oil and gas industry. So in orange, you see oil prices, and in blue, you see the North American total rig count for oil and gas. So as we, a lot of us know, we never thought we'd see sub-zero prices, which we did last year when we saw negative 40 a barrel. We're now in the low 60s a barrel, which is where some of the onshore drillers can start to drill profitably again, and maybe some ultra deep water. But Louisiana, which is a big center for offshore oil and gas, I think that the prices still remain prohibitively low for a lot of offshore drillers. And so that could continue to impact the local energy sector until pricing gets higher when global demand comes back with the economic recovery. And then you see in this blue bar, or the blue line here, that the rig count is still near historic lows as well. So part of this was pre-COVID. The industry had come under pressure. There was a lot of supply on the market because of the shale boom in the United States. And so we think, where we sit in Houston, that the energy industry faces some, pretty significant structural challenges going forward. But we're hopeful that a rocketing back in global demand will help the energy industry some in the coming years. And with that, I'm going to turn it over to Chelsea to talk about New Orleans hospitality.
Hi, good morning. I'm Chelsea McCready, and I joined CoStar about 4 months ago on the new hospitality market analytics team. I'm covering the southern region. So hospitality data just launched last week in the CoStar product. The source of the performance data is STR. I think you're familiar with STR, based in Hendersonville, Tennessee, which was acquired by CoStar about 1.5 years ago. So let's go ahead and dig in. You can see with the gray bars that typical New Orleans occupancy, that's kind of the last 3 years prior to the pandemic. So there's usually kind of a spring wave and a fall wave of hotel occupancy. The slowest month is August. Groups hesitate to book events during the peak of hurricane season. And then the winter months are also a little bit slower than the rest of the year. But last year, New Orleans hotels were impacted earlier than many other cities by the pandemic, since Mardi Gras was known as a super spreader event. So the worst month, of course, was April. That's consistent across the country. In New Orleans, that meant 18% occupancy. And then it kind of got a little bit better over the next couple of months, around 30% occupancy. I did see quite a jump in September and October, a little bit in November. Unfortunately, it's not because tourists returned. That was actually because of hurricane evacuees from Laura and Delta in late August and in October. So especially from Hurricane Laura, there were a lot of evacuees that stayed for even up to 2 months in the hotels nearby. Preliminary March data is not shown on here, but I can share, it just came out yesterday. Preliminary shows that March occupancy was 47%. So that's a pretty big jump. It's been basically 30% since last June, if you don't account for the hurricane evacuees. So to see it jump up to 47% occupancy is a great, it's just a great improvement. So the city started to open up, leisure visitors started traveling for spring break. That increase from February to March is pretty much in line with other southern markets. We did see it pretty much across the country. Seems like March is going to be a pretty good month for most of the country relative to the rest of the year. The first meaningful sign of recovery for this market, especially that's not hurricane driven. Next, we'll look at average daily rate. So it's the overall average price of a room for a night. The seasonality is similar to occupancy with those gray bars with the spring wave and kind of the fall wave. Last year, ADR didn't fall nearly as drastically as occupancy did, but it still fell. So it's been hovering between $80 to $100 since last June. February was about $91, and preliminary for March is about $99. So it's still in that range, but a significant improvement. Now, RevPAR is revenue per available room, and that is the VIP of hotel metrics. It's sort of a combination of occupancy and ADR. The number itself is a dollar amount. It's not that interesting or intuitive. So usually you'll see RevPAR in the context of year-over-year percent change. So in this case, between March of 2020 and February of 21, so it's a full year of pandemic data, the national RevPAR decline was about 54% compared to the previous year. Most large cities saw more severe declines due to their reliance on conventions and large events and international visitors, and typically stricter lockdowns in the bigger cities. So among STR's top 25 markets, New Orleans falls kind of in the middle of the RevPAR declines, it's around negative 68%, similar to Orange County and Orlando. Notably, New Orleans did do better than most of the other cities that were known for early super spreader events like Boston and Seattle. You can see those down in that bottom right corner with the hardest hit markets. And I'm sure part of that is due to the hurricane evacuees last fall. New Orleans would have been lower if not for that group. Switching gears for a moment here, we've got about 1,300 rooms under construction in New Orleans. So that's about 3% of existing supply, which is pretty much in line with the national average. It's a little lower than other large markets, but it's right there with the national average. So about 750 of those rooms are scheduled to open this year and another 550 next year. Beyond that, the projects that are in final planning right now in that lightest shade, those are more uncertain. I think everybody's kind of reassessing their plans for new hotels that are in that phase. So we're just gonna have to see what happens with those. But the ones that are scheduled to open right now in 2022 that haven't broken ground yet, I'd say they probably won't happen in 2022 if they happen at all. And the last slide I have for you here is it's just one interesting thing that sets New Orleans apart with respect to the hotel pipeline is that most of the rooms under construction are luxury and upper upscale, what we typically refer to as full service hotels. Most properties under construction across the country are kind of the upscale and upper mid-scale, so it's mid-tier, maybe select service type properties. But in New Orleans, many of these high-end properties they're adaptive reuse of historic buildings. So the Four Seasons in the former World Trade Center building, the Fairmont in the former Bank of New Orleans building, and the Canopy in the former oil and gas building. It's something that we're not seeing quite as much in most other cities. It's just an interesting thing that sets this market apart from most of the others. And that's it for me. If you have questions, please add them into the chat. We'll discuss at the end, and I'll pass it back to Justin.
Thanks, Chelsea. All right, so let's talk about New Orleans multifamily. So Apartments.com, you've probably seen Brad Bellflower in the commercials. This is a CoStar company. A good thing about working with Apartments.com is that we can see search data and we can use their back-end data in our multifamily platform as well. And so this looks at sort of all search activity in New Orleans for apartments. So you can see that when the pandemic first began in March and April, there was a lot of uncertainty. So there was a dip in that search activity. But then very quickly that rebounded, above the pre-pandemic, start of the pre-pandemic highs, and we had really strong search activity through most of the year. Started to wane towards the end of the year, where we tend to see a bit of a fall off in leasing activity during the holidays. That has since rocketed back at the beginning of this year, which is very promising. So we look at, we call this a SDV, supply demand vacancy chart. So the orange bar is absorption of units, the blue bar is new deliveries, and then the green would be vacancies. And then below you have annual rent growth. So just to address up top, so New Orleans has seen some of the most deliveries it's seen in its history. We had over 3,000 new units deliver last year. About 2/3 of those were in a 2-mile square radius of the French Quarter. But what was really noticeable about what happened with the pandemic, and by the way, this is the same thing that happened that we were seeing nationally, was a flight of folks from the urban core to the suburbs. As we shifted to work from home, as folks were under economic pressure, there were a lot of reasons why we saw this sort of exodus to the suburbs as people wanted to stretch out, have more space for their home offices, maybe seek some affordability. Maybe they were, rooming up with family as they moved out to the suburbs. So if you look at just this past year, 80% of the net absorption was in St. Tammany Parish on the North Shore. And you actually had very mute to negative activity downtown, whereas that's where most of the new development was occurring. So that's why we saw this vacancy rate increase. We're hopeful that as the economy continues to rebound, that there's a renewed interest in living downtown. And while millennials are, entering their prime home buying years and are eyeing the suburbs by and large, there is Gen Z right behind them, which is a huge, cohort right behind us, I should say, that, we think would still be interested in living in a downtown, type environment, close to work, close to all the nightlife and amenities in a sort of post-pandemic world. So we do see that vacancy rate start to come in, towards the end of this year, early next year. As far as rent growth below, it looks like it's been quite mute for a long time, but really the scale of it is sort of warped by what happened after Hurricane Katrina. So you can see that there was that really sort of skewed the data. But we have seen sort of flattening rent growth over the past year, and this was starting to occur even before the pandemic because of all of the new supply coming online and landlords having to offer more concessions and free rent to lease up those spaces. But again, as the pipeline winds down, we start to see more leasing activity. Hopefully, this will start to correct itself. So this is the rent trend, and blue bar is downtown apartments. In the red bar, this is suburban, and the green is sort of market. So you can see that rent activity, rents actually increased in the suburbs overall because of all activity, and then you see this huge drop off in the downtown French Quarter warehouse area. And again, we've seen this in almost every major city nationally. So this is not just New Orleans, this is everywhere. And we're just gonna have to continue to monitor how this trend plays out. Something that was bridging the gap that we learned of prior to the pandemic was you had these master lease short-term rental companies like Stay Alfred and Sonder, who were leasing whole floors in new multifamily buildings and converting them into sort of Airbnb-like units. Landlords loved it because they figured, okay, there's too much supply on the market. We're downtown. We might as well convert a portion of this to hotel. This seemed to be a great arrangement, but of course, when tourism got hammered with the pandemic, you had sort of, different things happen to different short-term rental companies. So this is from sort of the beginning of the pandemic, Stay Alfred closed for good. This was a company that was leasing a good amount of multifamily space downtown. But then you had Sonder, who actually went out and raised a whole bunch more money. And we think that the part of Sonder's success is that they're well capitalized, but also they shifted to a more sort of long-term rental housing or staycation type model where they're leasing out fully furnished apartments for shorter than you could with a traditional lease. So we think that some of this activity will continue to help multifamily landlords, but it'll be kind of uneven. Concessions, I'll just briefly touch on this. So you're probably not surprised, but with that increase in supply, we have seen overall an increase in concessions since before the start of the pandemic. They were at their peak in August and have come in a little bit. And so we'll continue to monitor that as well. But overall, landlords are having to give some more free rent, which could actually attract some younger renters and renters of all stripes to downtown. If we look at transaction volume, so transaction volume is down, was down last year, pretty considerably over what we saw in 17 and 18. The vast majority of multifamily trades that we're seeing are sort of value add, 3-star workforce housing, particularly in suburban areas. This remains a hot investment commodity nationally, and that is certainly the case in New Orleans. The fundamentals are great. We're not building a lot of new affordable housing, which is not great, but it is what it is. But investors like it because it's in increasingly limited supply. And in New Orleans, there's a lot of it. So just like in Houston or any of the markets we cover, there are a lot of national players who have continued to express really strong interest in workforce housing investments in New Orleans. And with that, I'm going to turn it over to Itziar to talk about New Orleans office.
Great, thank you, Justin. So with offices, a lot of them not being utilized, many companies have chosen to sublet their space, as many of their employees work from home, and they've even become a permanent staple in some of their operations. And we can see in this chart that since the fourth quarter of 2019, New Orleans sublet space has increased by a staggering 107%, and it actually only trails San Francisco in terms of percentage. So that's something that we're going to be monitoring. Now, in terms of rent growth, one saving grace has been the fact that New Orleans has seen very, very little new supply additions over the last decade, and that's allowed rents to grow this past year. So diving into leasing activity, leasing volume is down about 40% compared to the same period last year, as tenants have still just continued to delay these leasing decisions. And leasing volume is down about 30% for comparison compared to the period heading into the pandemic, the 3 years prior. So most of the leases signed are for spaces below 2,500 square feet, which is quite common for the area actually. And one of the largest recent leases signed, recent-ish, since the pandemic began occurred in September when First Bank and Trust signed a lease for a little larger than 30,000 square feet in the First Bank and Trust Tower, which is owned by the Hertz Investment Group. So if we take a look at the fundamentals, while New Orleans office vacancies were ticking up a bit prior to the pandemic, one saving grace is that they entered this crisis at 13-year lows and significantly tighter than major US markets, for example, like Houston. And just as a reminder, since 2010, on a net basis, more office space has actually been taken offline here than added. In fact, there's been about 3 million square feet of net demolitions, especially in the CBD, supporting what Chelsea mentioned earlier, this widespread conversion of older legacy underutilized office buildings into often higher yielding apartments, condos, and hotel rooms. Meanwhile, net absorption has been negative in the market in 6 of the past 7 quarters. So driving some of this negative absorption, for example, GE permanently closed last year its local office and vacated nearly 85,000 square feet from Place St. Charles. So vacancies now stand at about 7.3%, only slightly higher, about 40 basis points since where they were during the fourth quarter of 2019. And looking ahead, they may remain in that 7% area, though the next several years under CoStar's base case scenario, and again, just helped by these minimal supply levels. So since the outbreak, less than 20,000 square feet of broken ground. And in fact, 2020 marked construction starts were their lowest level on record. So looking briefly at rent growth, rents grew annually during this first quarter by about 0.8%, which is slightly down from the nearly 2% they grew last year. But it's worth mentioning that even prior to the coronavirus pandemic, office landlords had struggled to grow rents, which was directly related to just sluggish demand for office space. And under the base case scenario, we can see that rent growth could remain flat until 2022, by when most people should be fully vaccinated and a return to the office could have realistically occurred by many companies. So speaking of demolitions, this trend has persisted over the last year, and only two metros, Cleveland and Richmond, beat New Orleans in terms of negative net deliveries as a share of inventory over the past 4 quarters. And looking briefly at transaction volume was actually up about 30% compared to this first quarter compared to the first quarter of last year, but it was down about 20% compared to the average of the 3 years heading into the pandemic. And an interesting trend that we saw was that since the pandemic, more than 75% of buyers have been local private capital. And this is interesting because usually it's mostly national buyers that account for a larger share of transactions. And the suburbs continue to garner investor interest with areas like Medaille and Mandeville Covington, both accounting combined for more than 40% of all office trades during this past year. And what's usually trading is these smaller 2- and 3-star stock under 20,000 square feet.
Please, thank you.
So now if we pivot over to the industrial market. So looking at the manager index, it's a good leading indicator about the health of the economy. Above 50 signals an expansion, below 50 signals a contraction. And it's quite encouraging to see that manufacturing and non-manufacturing has rebounded quite substantially. And it makes it appear that we are recovering and we're on the right track here. Another interesting point is that manufacturing did not decline like it did during the financial crisis. So leasing activity, leasing volume is down about 30% over the past year compared to the average seen during the 3 years headed into the pandemic. And most of these leases signed are for spaces below 10,000 square feet, which is actually not uncommon for the area. And the area garnering the most leases over the past year, more than 25%, is the Elmwood Harahan submarket, which is actually not surprising because it's home to the largest amount of industrial inventory in New Orleans. And one of the largest leases signed since the pandemic occurred was Medline, which committed to nearly 200,000 square feet of space in Covington last August. So delving into the fundamentals, the vacancy rent has trended upwards in recent quarters, but it still remains quite low by historical standards at around 44%, about 70 basis points from where it stood at during the fourth quarter of 2019. Net absorption last year actually posted the worst result in over a decade, and this is directly weighed on vacancies. Much like the office sector, the industrial sector too has seen a lot of conversions and demolitions of industrial facilities, which has actually resulted in a reduction of industrial stock this past decade. So looking ahead, vacancies could tick up slightly through 2022, but nothing too dramatic. And under the base case scenario, they could remain below 5%. Again, thanks to just minimal supply. So noteworthy projects recently, a 140,000 square foot distribution center in Slidell broke ground just a month ago or so, and they're expected to have that finalized by 2022. And that's basically it for what's under construction. Taking a look at rents grew annually by 4.1% during this first quarter. And while rent growth fell to a 5-year low last year, they still grew by more than 4%, which is pretty impressive. Something worth mentioning is New Orleans hasn't benefited as much from e-commerce, despite being strategically positioned along that Interstate 10. And a lot of the exposure to regional and national tenants is lacking, largely because of its proximity to larger regional hubs like Atlanta, Dallas, and Houston. So looking ahead, rent growth may decelerate just slightly over the next several quarters, but should rebound strongly by 2023. And then for transaction volume is down about 30% compared to the 3 years headed into the pandemic. And buyers have been primarily out of state, private capital, with local ones taking actually a bit of a pause. So transactions have been pretty evenly split throughout New Orleans. But areas like Kenner, Elmwood, Harahan, and West Bank combined have accounted for more than 40% of all trades over this past year. And most of what's trading is lower quality 1- and 2-star stock under 40,000 square feet. One of the larger trades actually traded recently in March. It was a 50,000 square foot warehouse in Medellin, which sold for 3.2 million square feet at $64 per 3.2 million, sorry, about $64 per square foot. And the property was vacant at the time of sale, and the investor intends to lease it out eventually.
All right, so I'm just going to wrap it up, talk about New Orleans retail here for a second. So New Orleans retail leasing activity is down slightly from the period last year, but still remains sort of relatively strong. The vast majority of the absorption that's occurred over the last year has been in Slidell on the North Shore. We've seen a fall off in absorption in Metairie and Kenner and those areas where we've seen ACs and some of the legacy big box store closures really affect that market. And just as we've seen the rooftop growth, as you saw the incredible multifamily absorption on the North Shore, that's attracted a lot of the new leasing up there for big box, for pad sites, and just chasing those rooftops. So if we look overall, I mean, vacancies are pretty low in New Orleans, especially compared with historically. Vacancies around 4.5%. We've seen some negative absorption in the past few years. We've seen some of this in other major markets. I mean, retail continues to come under threat from e-commerce, and whether this actually presents an interesting opportunity for industrial. We've seen just absolutely incredible e-commerce growth throughout the country and in other markets as this distribution has started to pick up. And here's the fact. So e-commerce just a few years ago represented 10% of all sales. Now it's about 17%. In markets like China and Asia, e-commerce represents 60 to 80% in some instances of all e-commerce. And that's sort of looking into the future. We still think there's room for experiential retail, that folks will want to go into the store, but we think the nature of retail is going to change overall going forward. If you look at China and South Korea and some of these markets, they sort of skipped that whole period of building out, power centers and strip centers. I think South Korea, they just opened their first ever mall. So the formation of their middle class came a lot later than the United States. We're rather over retailed. And I'll talk about that in a second. We do see a declining rent growth over the next year. Again, as retail, traditional brick and mortar, particularly big box, continues to come under pressure. But we think that vacancies will remain low for the existing retail. And again, that the North Shore will continue to attract a lot of positive leasing momentum. So as far as transactions, transaction volume is also down somewhat from the prior year. Some of the acquisitions that we saw were acquisitions of sites for redevelopment opportunities. We're seeing more and more of this nationally as investors look to repurpose some of the older malls, repurpose some of the older big box into either new retail storefronts or to tear it down altogether and build another better and higher use, apartments, mixed use, what have you. So just to wrap up with a couple slides here. So this is looking at Simon Property Company, which owns a lot of malls and several in Louisiana. So they ended last year pretty sharply in the red. They even had trouble selling some of their properties, which just goes to show you just the big challenges that suburban malls in particular face, the suburban legacy malls. But that also represents a tremendous opportunity to go in and redevelop those. But what's interesting, Simon did something very interesting. They saw a lot of their biggest retailers start to fail, go bankrupt during the pandemic. And they said, you know what, we're going to invest in those companies. We're going to essentially buy them. So Brooks Brothers, J. Crew, I believe Forever 21, and a few others, Simon invested heavily in those big, large tenants of theirs to save them. And this was actually turned out to be a saving grace because these companies have been generating an increasing share of e-commerce sales. So Simon posted $3.5 billion in revenue in the fourth quarter as a result of their investment in those retailers, simply because of online shopping. So this really goes to show you the direction that the market's going. And that's what we've got. I think we'll open it up now to Q&A. Jeanette?
Thank you, Justin, Chelsea, and ECR. This was great, and I love that you guys covered, residential, commercial, retail, industrial. This was very, very informative. I'm just curious. We don't have any questions in the chat, so everyone, if you have anything to ask, please feel free to put it in there now, and we can get those questions answered in real time. Justin, I'm curious. Do you or your team have any interesting examples from around the country of how abandoned or closed up malls and large retail properties like that have been redeveloped into different uses?
Yeah, absolutely. So the first one that comes to mind here in Houston, several years ago, Midway Companies was kind of ahead of the curve. They bought Town and Country Mall, which is one of these that I believe it had a JCPenney. It was an older mall that I believe from the 60s or 70s. It was kind of aging out, but it was in Memorial. And so it was right at the intersection of Interstate 10 and the Beltway 8 tollway. And so it was at a great location in the energy corridor in the middle of these nice neighborhoods. And so they developed it into award-winning mixed-use center. They just completely razed all the old mall buildings, and they built, like European style sort of, lifestyle center, walkable retail with apartments on top. They built new office buildings. Marathon Oil is moving to a new building there. So just with a variety of uses, there's some hotel, they have a park with programming, and so really turned it into an attractive mixed-use center. I think it's USAA that has also been on a bit of a buying spree in Brookfield. Brookfield, part of their big strategy when they bought, is it Rouse, I think it was, they bought a huge retail company. And I think part of that was a major land grab because they saw all of these underutilized suburban malls in these really attractive areas where there's a lot of affluence. They figured, and they were very well located on highways, they figured they could turn those into mixed-use projects.
Great, thank you.
We're also seeing, and one thing I'd add is depending on the area, we're also starting to see some of these malls converted into last mile e-commerce distribution logistics like Amazon and others are converting those into those kind of uses.
Got it. And we do have a question in the chat from David Cray. He's asking, are you seeing development of hybrid workplaces or hub centers in suburbs for remote workers to meet? So you mentioned as an example, St. Tammany Parish on the North Shore in our area, a lot of residential, development there or demand. So are you seeing these hybrid workplaces or hub centers popping up as a response?
What we're seeing nationally, and this is, I wrote an article, I contributed an article to the Houston Chronicle a few weeks ago about this and what we're seeing in Houston. We haven't seen that so much. I think there was sort of a gut reaction to the pandemic, and most of us have just been working from home. And as people start to get vaccinated, as the economy starts to reopen, I think that thoughts of drastically changing the office might change a bit. There's a sort of a broad consensus that we may all go back into the office as we know it. Maybe there'll be some reconfigurations of space, and maybe the companies go to a more flexible hybrid model where they'll allow employees to, only come into, they'll say you only have to come in the office 3 days a week and you can work from home, a couple days a week. JP Morgan just announced, as part of their big move to their new office in New York, they're going to let 10% of all their employees globally work from home permanently. So some companies, you've seen the big tech companies like, I think it's Facebook and Microsoft and others, and Google make a huge commitment to basically going back to the office as they were pre-pandemic, because they see the value in collaboration. Other companies like AT&T, they're trying to go with almost as full work from home as possible. So I think it just really depends on the company and the culture and how they're able to manage their operations, either in person or remotely. So it's a mixed bag.
Got it. And then we had a couple more questions. First, are you all seeing any ESG investment requirements for new or existing properties from developers, lenders, or investors? And you might want to define ESG for the audience.
So environmental, social, and governance. So I moderated a ULI Rice panel last week, and we had one of our panelists was Claire Thielke with Hines. She's former COO of Hines Investment Management and now runs Hines out of Asia. She's a rock star. She's a Houston native. And she was saying that she is starting to see investors. It's sort of starting to trickle down from the investment community. I think the question was, is ESG is it becoming more of a trend in investment?
Right. Are ESG investment requirements for new or existing properties from developers, lenders, or investors? Are you seeing this become popular?
It's starting to become a trend. I'm just going to echo what Claire said, is that you're starting to see where you'll see things like investors requiring that the companies that they invest in, that they're focusing more on using third-party vendors who are, women-owned businesses, minority-owned businesses, using more contractors that meet certain thresholds in that regard. That was sort of the biggest one. It sort of varies by the investment community, but yes, for the big investment houses, pension funds, life cos, you're starting to see more and more of that, generally speaking.
Got it. Another question from another attendee. Do you have any data or trends specific to build to rent single family properties?
Build to rent single family, that's a really good question. We just are in the process where I think we're beta testing, or we're building out a platform that's going to look at single family and particularly look at this part of the market. It's not available yet in the product. I don't know when that's coming. I know anecdotally, it's not something we usually do, is shout out, but where Itziar and I both used to work at HFF, now JLL Capital Markets, they have just established a whole practice that's entirely devoted to single family. So not to give preference to any one group, but I know for a fact that that group has launched a single family practice, and I imagine that they're gathering data on it.
Thank you. And another question from another attendee. Please speak to any local or national opportunity zone successes or trends. Have you seen the opportunity zone tax treatment and benefit really have an effect?
Yeah, so this is It's a loaded question and it's a great one, and one we might actually dive into in a future program. I think so we'll have an expanded conversation about this. And so I spoke on an Opportunity Zone panel before the pandemic. Basically, so how the Opportunity Zone program was enacted is that it was based on data that was 10 years old. So it allowed for some areas that were developing, were already kind of mature. Also, there were submarkets, or rather, neighborhoods, areas that were allowed into the Opportunity Zone program, and they were adjacent to areas that were, below a certain income threshold, again, based on data that was 10 years old. So what happened is that there was a smaller percentage of all the Opportunity Zone land area, and the vast majority of it is in rural areas where it's hard to make a development case. Maybe there's an industrial case or, some sort of community-focused case. But then there was a small percentage of Opportunity Zones that were actually located in really attractive areas. And I'll give you a few examples. Downtown Houston is an Opportunity Zone. Don't know why, but it is. You have parts of Brooklyn that are an Opportunity Zone, and you think, wow, but Brooklyn Heights, I mean, these are areas that were already well on the way of being gentrified. I think downtown Seattle, downtown Portland, Oakland, I mean, again, areas that were all very hot. So what happened was investors are smart. They saw that those areas were already on fire for very clear reasons, path of growth, a lot of great economic drivers. So they targeted those areas. And the thing with Opportunity Zone, and this is the last thing I'll say about it, is that you can only invest capital gains. So it sort of limits your investor pool to funds that have pooled, credited investors that have, or companies that have to reinvest capital gains, which is a pretty small percentage of the population. So I believe the Opportunity Zone program runs out at the end of this year. I'm not sure if it'll be extended or not. So there's kind of this rush to get in and take advantage of certain opportunities. But, if it's in the right area, if it's well executed, my personal opinion is there needs to be some more sort of oversight to see that those projects are actually accountable to the neighborhoods that they go into, that they have the intended positive effects on the neighborhood that they're supposed to. And you've seen local governments and civic groups and chambers of commerce layering on incentives to make sure that those dollars, that the Opportunity Zone program actually works as it was intended. We'll talk a little bit more about that on the next.
Sounds good. Yeah, no, and we can relate to your comment about some interesting tracks in terms of OZs, because downtown New Orleans and the Bio District has multiple Opportunity Zones within it. And it's like, that's pretty expensive real estate. There are no more questions in the chat, but I just had one quick one, just out of curiosity. And I don't know if this is for you, Justin or Chelsea, but when Chelsea spoke to hotels and she named a couple of examples in downtown New Orleans of existing buildings that are now becoming, luxury hotels. Is there like a rule of thumb in your industry of, within a certain geography, like within New Orleans, how much is too much saturation of commercial space, for hotel? Like when does it get kind of scary? Like too many of our offices, commercial office spaces are now being converted to hotels. And is there a tipping point where you've seen historically that that's kind of dangerous or anything?
I'm going to let Chelsea give that one.
Yeah.
Honestly, this is a pretty recent trend from what I've seen. I mean, it's happening in a couple other cities with certain properties, but it's not happening to the extent that it's happening in New Orleans. So I don't know that I can speak to the historical trend because it's not something I've really seen happen very much.
Got it. Okay, I was just curious. There might not be an answer, but with COVID, we just get sensitive about being overweighted in certain industries. As you mentioned with your unemployment rate data, we were hit harder than the rest of our state, and we were hit harder than national rates because of that. So that's why I was asking.
Yeah, I mean, I would just sort of add to that. I mean, you saw in Chelsea's chart that before the pandemic, occupancies were north of 70%, 80%, which I guess is pretty healthy, sort of overall nationally. So it seemed like even with the projects in the pipeline in a normal post-pandemic world, it seems like, New Orleans could handle that spare capacity. It's just, it's hard to tell right now because we're in such a weird gray area with COVID-19 and getting out of it. But if the tourism sector experiences anything like we've seen in the rebound in, you know, spending, manufacturing, even employment, et cetera, if that starts to sharply increase, then I mean, hopefully it does completely change the dynamic.
Got it. Well, thank you all. I'm sorry, Chelsea, did you have any more to add?
I was just going to say that nationally, we're talking about the recovery in the hospitality sector, and one of the biggest kind of issues right now is the rate and whether or not that's going to be able to come back strong, because historically it does take a long time after recessions for the rate to come back. And that might not be as much of an issue in New Orleans with these new high-end properties opening. Just the fact that those are the higher end properties, they will command the higher rates, and that might actually help the New Orleans recovery.
Thank you both. We just had one more question in the chat. Will New Orleans East see more development, industrial or distribution? I can say on behalf of NOLABA that is an area of strong interest to us. So we have lots of stuff in the pipeline, but I don't know if the folks from CoStar are seeing anything from their data that can speak to that borough of New Orleans.
Yeah, no. So currently, right now, there's just those two projects under construction. The Fuji oil, which should come out by this summer, and then that warehouse. So and proposed, we don't have those projects quite yet.
Right.
Yeah,
and
I
mean,
candidly, I'm surprised that there hasn't been more of that activity, because we've seen such an explosion of. This is maybe something that I need to delve into more, but like where the sort of the Amazon Prime packages come from. You know, maybe they're in partnership with FedEx or some of the others at this point, where because I know that they have strategic partnerships in other markets, but I mean, that's been absolutely dominating what we've seen in Texas. And so I wouldn't be surprised if some more of that activity was coming in the industrial sector. Just as e-commerce, I mean, like I said, e-commerce is 17% of retail sales, or at its height it was. Rather now we see it settling back at about 12% for the time being, but it's 60 to 80% in Asia. E-commerce is a share of retail. So if that's where we're headed as a country, then everywhere is going to need more distribution space.
Great. Okay. Well, if there are no more questions, I just want to thank everyone for being here, and thank you for the questions and participation. We also want to thank, of course, the Urban Land Institute for being a part of this journey with us, and CoStar for partnering on the series and continuing to bring such valuable content. I think Justin gave a little hint. There will be some Opportunity Zone content coming soon. Our next real estate event will be on Thursday, April 29th, and will be our first 2021 Real Estate Breakfast Series. And with that panel, we're going to have a really dynamic panel, some very interesting perspectives and some well-established folks who will discuss the effects of COVID on hospitality, tourism, and real estate, and then their future projections from a very local perspective. Local meaning they are here in New Orleans, but they could be massive global corporations or small business owners and real estate owners and such. So you will receive information on that as we get closer to the date, and we hope that you will join us on what is sure to be a great event. And also on the screen, you should be able to see some upcoming ULI events. So again, thank you for joining us, and hopefully we will see you back here on Thursday, April 29th.